guys, welcome back to the Mortgage Update with Dan Frio. I, of course, am Dan Frio, and today we're going to go over rent versus buy. And a lot of young people are, does it make sense to buy? Does it make sense to rent? I'm going to move in 5-6 years. What should I do? So that's basically the question we're going to answer today. And it's going to depend on, who you are, where you are, how long you're looking to stay there, maybe how much you're going to put down, what's the rental analysis in your area. There's a lot of factors involved. So what I'd like to do is, first of all, hope you like my videos. If you do, please give me a thumbs up. Don't forget to subscribe down below. And if you want an analysis done for you individually, do me a huge favor. You can go to my website, and over on the mortgage calculations or resources, there's click down in mortgage calculators, then scroll down to the bottom. It has a rent versus own. But if you want one of these for yourself, I will do this on your behalf. Just shoot me an email, and the best way to get me is Frio, which is Frio at Gmail. I always say that. dfrio at parksidelending.com. Okay? So, or you can reach me at a toll-free number is 844-775-LOAN, and I can help mostly anyone throughout the country at this point. So I'm licensed all over the country except for a few states. So if I can be of any help, reach out to me, please. Here's an internal system that I have. It's more in depth than what you would have, so I can create this on your behalf. So here's all the things that we have. So I'm going to go over to calculators, rent, buy versus rent. What we're going to do is we're going to go in here and say, okay, I want to buy a home, and my home that I'm looking for is $225,000. Where do I live? Well, let's say, for example, I live in Florida. So we're going to pick out Florida. And what part of Florida do you live? I don't know much of anywhere, but I'm going to put Brevard County. Okay, so it's going to pull up some data here. And what it's telling us, and it's pulling this data from national averages. Okay, so it's saying, let me put some data in here. I want to spread that open so you can see. The average rent in that county right now is $19.68. Renter's insurance, so the content insurance of all the contents in case the house burns or the building burns, it'll cover your stuff. It's $30 a month, and the annual increase in rents per year is 4.9%. That's pretty high, but again, these are averages throughout that this system is pulling from data in those counties, those specific counties. Okay. So then down through here, it's saying, okay, $225,000 home. The real estate taxes in that area are 1.03% of the value of the home. So that's that. Your homeowners insurance, mortgage insurance, and other things are included in here. Okay. Cost to sell the house. It's not going to be 6%. Nowadays it's 4%. So we're going to load that in. So what does this do? Is it beneficial to rent or buy? So we're going to go through here. We're going to look at a 9-year average. That's usually about the time people move, sell, do certain things, either refinance or whatever. So let's see what the comparisons are. If you bought a house, your mortgage payment would be about $1,432 versus the $1,998 in rent you're paying now. After 9 years, what would that rent be? Well, you're in a fixed rate loan, so that your payment's really not going to go up that much other than whatever your real estate taxes go up. Okay? So in 9 years, that rent is going to be $2,930. All right. So what this does is it analyzes what's the difference in the cash flow of what you would pay on the mortgage versus your rent. Well, you'd be $106,000 ahead if you bought a house. Okay. So the next thing is, how about appreciation? If you rent, there's no appreciation. But if you buy, it's factoring in the appreciation rates in this state and county, and it's saying that you would gain $60,000 in home value over that 9-year period. All right. And you would pay down your mortgage $36,000. So you would have $36,000 in equity built in for a total, when you total everything up, after 9 years, you're $187,000 ahead if you buy the house. So let's say, for example, Well, I'm not going to be there 9 years. I'm going to be there 7 years. You're still ahead of the game, $116,000. How about 6 years? You're $86,000. How do we figure this? Okay, so here's the numbers here. It's the appreciation gain, so the house value gain. The amortization gain, so that is how much in the loan pay down that you did. So let's go back to a 9-year because we went through those numbers. So you have $60,000 in appreciation, that's there. You have $36,000 in amortization gain, that's there. That's a pay down of the loan. It's not factoring in any tax benefits, which you will have tax benefits, and a cash flow differential of rent versus own of $106,000, less the cost that it cost you to buy the house and the cost that it'll cost you to sell the home. So in this case, it's better to buy by far. Even if you're in the house for 5 years, 4 years, you're still way better off buying the home. So let's say, for example, let's see if I can find a spot that it doesn't make any sense. So let's go to, and I don't know where this is going, so I'm doing this live, Connecticut, Fairfax. Here we go. Okay, so in this case, I just want to make sure I'm not doing this on a bias basis because I'm a mortgage person. I want you to ask me, does it make sense for me to do this or not? So in this case, it might not. Well, it still looks like it does. Okay. So in this case, we kept everything the same, but you'll notice that your mortgage or your monthly rent payment changed because, again, it's pulling data from this range, not from the Florida area that we looked at previously. Renters insurance changed a little bit. Annual rate rent increase was smaller than it was in Florida, so we got that. Okay, so we scooch over here to buy this property. It'd be $1,500 a month in mortgage payments. To rent it, it's $1,255. I don't want to look at a 4-year rent. Let's look at we'll go to 7. 7's probably a good factor. Okay, so over 7 years, your rent payment still isn't equaling what your mortgage payment would be. So that's bad. It's a negative. Okay, but let's see what other benefits are there. So we go down through. And we have appreciation of the property of $127,000. That's a lot of appreciation gain. You have an amortization gain, which is a decrease in your loan balance of $27,000. So what we do is we factor in all these numbers. So does it make sense? You're $120,000 ahead in this case too, even though your rent is $300 less at the beginning. Over time, that is going to increase every year. The national average right now is 3.7. So if I put 3.7 in here, it even make these numbers look better. So in this case, you're still $120,000 better off if you're there for 7 years. Let's go to 5 years. Still better off. 4 years. Still better off by $50,000. So, in most cases, it is going to benefit you to buy a home. So again, I hope you like the video. I hope it makes sense to you. If you want one of these done for you individually, and I'll specify it, I can put in any numbers that you want in here. You want a $150,000 home, you want a $200,000, you want a $500,000, just give me the specifics. Again, you can email me at dfrio, which is Frio, at parksidelending.com. And you can kind of play around with a very generic version of this on my website, which is themortgageupdate.net. But I'd love to hear from you. So if you want me to run some numbers, please comment down below. Or again, send me an email and I'll do a customized one for you and I'll email that out to you. So I hope this makes some sense for you. I hope you learned something. God bless. Please make sure you share some comments and share the video if you would. So God bless. Have a great week. Take care. Talk to you soon.